You are paying for a lie. That cash value life insurance policy your agent sold you as an investment is actually costing you over $150,000 in lost retirement savings. Here's how the math works, why it's a trap, and what you should buy instead. Most people never run the numbers, but I did, and the result will shock you. According to a 2025 LIMRA study, 42% of millennials now own some form of permanent life insurance, up from 28% in 2020. Yet the average cash value policy has a surrender fee of 7 to 10% of premiums in the first 5 years, and the internal rate of return rarely exceeds 2 to 3% annually. Meanwhile, the S&P 500 has averaged 10.5% over the last 30 years. This gap is silently destroying wealth for a generation that thinks they're being financially smart. Think of cash value life insurance as a financial aquarium. You put in expensive fish, your premiums, but the water is murky, the filter is clogged with fees, and every time you try to take a fish out, borrow cash value, the store charges you a handling fee and lowers the tank's temperature. Meanwhile, a simple index fund is like a self-cleaning ocean. It grows naturally, you can take fish out anytime for free, and there's no salesman watching the tank. Number 1. The fees are a hidden leak. Most whole life policies charge a front-end load of 5 to 10% of every premium, plus annual administrative fees of $50 to $200. Over 30 years, a $200 monthly premium loses $7,200 to fees alone, money that never sees a dime of growth. 2. The return is worse than a savings account. The average cash value growth rate is 2 to 4% after expenses. Compare that to a high-yield savings account at 4.5% or a bond fund at 5%. You're literally losing purchasing power to inflation while thinking you're building wealth. 3. The surrender penalty locks you in. If you stop paying premiums in the first 10 years, you lose 50 to 100% of your cash value to surrender charges. This is a golden handcuff that prevents you from switching to better investments when your financial situation changes. 4. The tax advantage is overhyped. Agents boast that cash value grows tax-deferred, but so does a 401k or IRA, and those accounts give you an upfront tax deduction. Plus, loans against cash value are taxable if the policy lapses, turning your tax-free loan into a tax bomb. 5. The opportunity cost devastates retirement. If you invest $200 monthly in an S&P 500 index fund, earning 10% for 30 years, you'd have $452,000. The same money in a typical whole life policy, with 3% growth and fees, yields just $113,000. That's a $339,000 loss, enough to fund an entire retirement. Stop treating insurance as an investment. Buy term life insurance. It's cheap, simple, and covers your family for 20 to 30 years for under $30 a month. Then take the difference and put it into a low-cost index fund like VOO or VTI. Your future self will thank you with a nest egg that actually grows. If you want to learn how to build a real retirement portfolio, watch my video on the 3-fund strategy next.